Hi everyone, and welcome to Philanthropy Impact's Walk in My Shoes series for professional advisors. Thank you all for joining us for our last event of 2020, and we are once again changing things up and having an interview with style chat, this time addressing the issue of skepticism around social impact investing. My name is Zofia and I'm the Director of Membership and Development here at Philanthropy Impactor and your moderator for today. I'm coming live today from the middle of the Jersey Finance Conference, where we are media partners, multitasking to the extreme. And this is probably the legacy left after 2020. The world is now at our fingertips and we can be in two places at once. As this is a 30-minute session, we are taking questions. So please use the chat function to introduce yourself and have your say and post questions to our guests. And we ask that you remain respectful throughout, please. And that leads me to introduce our interviewer for today. He's the chair of our board, Rennie Hoare, who is partner and head of philanthropy at Hoare & Co. And it is with great pleasure that we also welcome Gary Vaughan Smith, Chief Investment Officer at SilverStreet Capital. Thank you both for joining us today, and I will now hand over to Rennie to make us start. Thank you, Rennie.
Thank you, Zafir, and absolutely seamless multitasking. Very, very good to have taken you from Jersey to introduce this. So, Gary, it's a real pleasure to have you with us for this webinar. I think a huge depth of experience, and obviously with SilverStreet having been set up 13 years ago, there's a serious track record of having done impact investment and a lot of experience for us to draw upon in this half an hour. Certainly to the audience, I would echo Zafir's points and say, do ask questions, and I'll try to get around to as many of those as possible. But for you, having done impact investment for 13 years, we hear that Resonance Fund has been investing in impact investment for 18 years. It's taken quite some time for impact investment to be the overnight success that it is. And I'd just like to start, Gary, with understanding, is this something you've always labelled your investment style as, impact investment, and how was the genesis of that, and how did people absorb it when you did initially go to the market with your new way of investing? Oh, you're on mute.
Yeah, thanks very much, Rennie. And thank you very much for the opportunity to speak and tell you a bit about our journey. The short answer is yes, we've always labelled it impact investing, and that was always our intention. My background, I'm originally from Zimbabwe and grew up there and went to university in South Africa and spent my career in the city in London in fund management, and spent a lot of time shuffling paper around, buying this, selling that, and making money for our investors, making a return. But I got to a point in my career when I wanted to do something that created a positive impact. And there seemed to be these great models in Africa related to the agricultural sector, and I wasn't really an agricultural specialist. But I could see there the overlap of return and impact, and it attracted me. And so we set up SilverStreet, and I was trying to achieve something where you bring capital in and it creates a multiplier effect. And this model that we're using, where we're focusing on smallholder farmers, that's what I saw. We presented to our investors, our old investors and pension funds, mostly in Europe, US, and I showed them the model, and I said, is this okay for you to? I know you have a fiduciary duty to focus on returns, but we think we'll get the same return, but with an impact. But does it somehow divert you or make it more difficult to get investment committee approval? And to a person, they said, no, you should keep this in. This is important, keep it in. So from then, we've always kept it in and continued as impact investors right from the beginning.
And I think people then might feel, I can see how it's baked in, but is there a trade-off that you feel that you're going through by having this impact lens, or for the bit of the market, do you think that actually they're completely compatible?
In certain types of investments, there are trade-offs, but where we've chosen to invest, there isn't a trade-off. And in fact, if you maximize impact, you also maximize return, and that's what you're looking for, that alignment. And I can give you, maybe if I just give you the background on what is the problem and what are we trying to address here. And our target impact group are smallholder farmers in Africa, and they typically have 1 to 2 hectares of farms. They're typically run by women in the household. 2/3 would be women. Men are often in town on the mine somewhere else. And they achieve, the poorest group in the economy, very low incomes, because their yields are low, their tons per hectare, and the price they achieve for the crops that gets low because they're growing low value crops like cassava and maize. And so that's our target group. And we look at, well, why is that, and how can we fix that? At the same time, within Africa, the population is growing rapidly. It's roughly going to double by the year 2050 to over 2 billion. And there's a shortage of protein, and it's just causing stunting in children. So there's a nutritional reason, there's an income reason, and finally there's a climate reason. So the techniques that the farmers are using are unsustainable. They tend to involve monocropping, and they tend to it means that they can only farm that hectare or two for 6 years perhaps, and then they have to move on and cut down the savanna woodlands next door. So how do we fix that? So, you know, that's our problem. And so we're focusing in on that smallholder farmer as our target impact group and trying to understand how we can improve the situation. And it's about raising sustainability and yield and on those farms. And it's totally aligned, because firstly, you have to fix inputs going on to the farm, the right seed, having the right technique as well on the farm, which is involving training. And then finally, can you create a market for those farmers in a higher value crops? Instead of growing maize, can you grow tomatoes? Can you bring in the tomatoes in rotation, or soybeans, or whatever it is you bring in? And so that leads naturally to certain types of investment that are totally aligned with impact. So we've invested in a seed company, which has hybrid seed, improved seed, so it improves the yields per hectare, the tons per hectare. And a lot of academic studies have shown that if you switch to the right seed, hybrid seed, which is not GMO, it's the old-fashioned hybrid, and the right technique on farm, which is conservation farming techniques, which was developed in the 1930s in the Dust Bowl era in the US, not by us, but those techniques which are highly organic and using a mulch, composting, and so on, that can double your yields. So the yields in Africa on these smallholder farms on corn are 1.5 to 2 tons a hectare. The average globally would be about 6, but we can get them up to 4 just with the right seed and technique. So we've invested in a seed company. The more seed we sell, the more we can get the technique and that message out. The higher the profit, but also you're doubling food production, you're more than doubling incomes. And also you're reducing climate risk, because the same farmer can produce more on the same hectare and doesn't need to keep moving, because you're now bringing rotation crops and so on. So that's what we're looking for, is the alignment. And there are a few parts of the agricultural value chain where you're totally aligned, and that's what we're interested in. There are others where you're not, and you need to just be careful about this.
And when thinking about the financial returns, then I think we understand that the impact of the doubling of incomes and the producing of more food, and certainly that climate impact is hugely powerful. What type of financial returns are we talking about in the different investment products?
So our products are private equity-like. You know, they require long-term patient investors, mostly pension funds, foundations, endowments, and some government funds. So like we have UK government, Danish government, Finnish, and the US. They're funding us in one way or another. And our second fund, for example, the returns are just over 16.5% per annum over the last 4 years. And so we're getting those are, you know, unleveraged real asset type returns. Anything north of 5 really is can be acceptable, but anything north of 8 would be a good result. And we're able to achieve that with with very large impact. So in our second fund, you know, we obviously we've learned ourselves, but the certain parts of the value chain that just have this massive impacts and are attractive investments. So the seed sector, the poultry sector, a few others. And we now, we define impact as, are we benefiting somebody else's incomes, not our own, not our companies, and by how much? So we want to quantify that, and it's 340,000 people at the moment have seen their incomes rise because of our actions, and on average they've risen about $350 per annum. It doesn't sound much, but they're coming from $500 average income. So it's the poorest group, so it's increasing about 60%. When you work through the numbers, it's over $100 million per annum of incremental income those people get, and it's sustainable. That's what I'm looking at. It's not a one-off. It's not a gift. It's helping people farm better, get more income more sustainably, and that's why it's such a, for me, it was such an attractive impact project. You know, it was this area.
And I see, Lucy, thank you for putting your question in the chat of how to mass affluent access these type of investments, and also the returns attached to it. I hope that slightly addressed the return side of it, that there really isn't a giving back of returns. I think on the access of products, there's obviously the Schroders Big Society Capital investment trust, which is being launched. There's Snowball, which has the idea of going towards an investment trust as well. And then I think looking at the big exchange, which has been set up by the Big Issue group, that's a good way of having a platform that any investment on it is rated gold, silver, bronze, and people can put their ISAs to work there as well as their pension. So that seems like a good way of going into it, and sort of leads me on, Gary, to think about, when thinking about your investors, you've talked about a lot of institutional investors. Are you also taking in blended finance, and what's the use of that in terms of your model?
We have brought in some blended finance from the US government, and we use it primarily for working capital funding. So the way we look at it is there where the issues are. We're trying to solve issues in Africa. You know, can you get access to bank funding just for normal cyclic, you know, your monthly working capital needs. So for example, if you're selling feed in a poultry business, you're buying your inputs, your grains and your soybeans at a harvest period. In Tanzania, that's the third quarter of the year. And then you're selling your feed evenly through the year, and you have to finance that mismatch. And that's very, very hard to get locally. And the US government, the DFC department, has lent us $100 million, which we use to finance working capital. And that's again, it's patient. You're not renegotiating with banks annually. But you have to do that. You have to have very high ESG standards, and you know, the positive impact, everything that goes with what we're doing, and be addressing these difficult markets, low income economies and the poorest group in those economies.
And when looking at your investment, obviously people could see it through maybe a single SDG, but from discussing it a bit further, it looks like it's very much, you're hitting on a number of different sustainable development goals. How do you measure impact, and do you feel the sustainable development goals are a useful quantification tool?
Yes, I do think they're useful. This is an unusual area where there's definitely more than one of the SDGs, you know, that we are addressing, which is one of the reasons I like it. It's not specifically one or another, but there's probably five, you know, I would talk to. It's mainly, you know, no poverty, aiming for zero hunger, climate action, gender, and then growth, economic growth, life on land. I mean, all of these, it's helping. The most important from our point of view is related to poverty, incomes, and then climate. So how can we reduce climate impact? How can we maximize income? And then we quantify. My training is I'm a mathematician, statistician. It's not good enough. It's nice to have anecdotes, people specifically how you've helped them, but can we quantify? And some basic stuff at the beginning. How many people are we employing? How many smallholder farmers are we benefiting? The answer is 340,000. How many do we employ? Over 10,000. How much has that increased? So we've created 3,000 jobs. So the job side, that's good. It's really good. And the technical jobs, the high paying jobs. But the real impact is the smallholder farmers. It's 340,000 people. How much of their income's risen, and how much, so how much of the people we're working with on the poultry side differ to on the seed side on some of the other areas, and where are we seeing the maximum benefit? And then we're also trying to quantify things like protein production, climate. We're trying to figure out the right metrics to use. We're still working on that. Like, how do we quantify the positive climate benefit? And there's certain things we can, and then we want to do a much more bigger quantification of it, because the broader implications are very significant in terms of how much one can prevent deforestation, basically.
And how comfortable are investors in coming with you on the impact journey? A lot of people like certainty, but in the impact investment space, are people encouraging of trying to develop new tools and new ways of quantifying what you're doing?
Yes, there's no doubt. It's a very positive environment, and people, I've worked in fund management. I've sort of cutthroat fund manager all my life, but that's why I wanted to do this when we started SilverStreet 13 years ago. Well, can we also create an impact? And what you find as soon as you take that step, that a lot of people will want to help you succeed. And I've never had that before. But when we talk to someone, in the US government or their department, or it might be a foundation that we're partnering with. We partner with Caritas on the ground, the Catholic Church. It's got fantastic networks, smallholder farmers, partnering with, the World Poultry Foundations, funded a lot by the Gates Foundation, etc. You partner with them, you have common goals, you're trying to achieve an impact. And it's people are very, very helpful. I mean, I think it's, I can't exaggerate it. So it does encourage you all along the way, the whole time. You're getting support, whether it's just verbal or actual, introductions, or it's partnering with people on the ground, with teams on the ground, etc. And with the fundraising, when we are raising funds, I think that the impact theme is no doubt amongst family offices and institutions now that it's becoming really important, and it's actually driving a lot of investors. They are passionate about it.
There's a couple of questions that have come through. One is about the mismatch of possibly local currency exposure and then getting US dollar returns. And do you have to use currency hedging to make sure that you get your returns coming through all right?
Yeah, thanks. We can use hedging if we want to. We've used very small amounts from time to time, but it's very specific situations. But we tend to choose those parts of the value chain where there's less currency impact. So it's part of you're trying to get an investment thesis and an impact thesis together. And I think we're slightly lucky maybe in our sector that a lot of it is basically hard currency type of business. There are parts of it that aren't, but we're not in those parts. We do have some, but not a significant exposure. And so we manage it explicitly. We're trying to stay with the hard currency areas, where it doesn't have to be precisely correlated, but over 2-3 years, you're going to get a hard currency type of profile in your your returns.
And another question's come through, and I think this is interesting. From the prep call, we discussed dairy farming and how there might be mismatches between the impact return and the financial return. And the question was about going in and seeing whether there's impact cattle and dairy farming that can be done. Is that your experience, that there's a possibility there?
Yes, with cattle in general, but let's say we don't do dairy, but if we just take dairy as an example, you're obviously going to have an emissions conflict there if you go into dairy. The other thing about it is you have a currency exposure that I was just talking about. So you're going to sell milk in local currency in that country. And depending, a lot of your costs might well be dollar going in because the equipment set up, etc. Finally, broadly speaking, it's a commercial farming type operation. It doesn't have to be. We know some NGOs southern Tanzania, some foundations have been quite successful giving everybody a cow, that type of approach. And then it provides income. But then you've got to follow up with the cold chain. And somebody's got to do that. And who is that? And how do we affect that? It's quite tricky. And then finally, there's a market demand. In different countries in Africa, some people actually prefer powdered milk. Some countries, whole countries, prefer powdered milk. And so you don't want to do that in those countries. So there you can see if your target group are smallholder farmers, you can see that it's probably a limited group that you're going to impact. It's not a big area, and it has certain unattractive features on the climate side and on the return side. So for us, other things being equal, we wouldn't consider that an attractive possible thing to do. So for us, dairy is not of interest for us, and we wouldn't be investing there.
So having defined your niche, having had a big track record of delivering the returns that you're hoping for, and also the social and environmental returns alongside financial, do you feel that professional advisors, there's a specific role that they can play in getting their clients with a better understanding of this? Is there more that they could be doing?
Yeah, I think professional advisors have a huge role, and where we've worked well with professional advisors, advising family office, particularly the larger family offices, you often get the second generation who are very interested in impact investing, and then need to learn. And even for people in the sector, yourself, myself, we're still learning who the other players are. Who else is out there? Who's doing a good job? Who can we learn from? And I think there's a big role there for financial advisors to seek out the better impact investors and bring them to their clients, because there is demand. Yeah.
And do you find it's globally spread where your investors are coming from? Or is there more of a European flavour, or where's the demand that you're seeing?
It's mostly it's Europe and the US. So our investor base is split roughly 50-50 actually. And it's dominated by family offices and institutional investors. So family offices, there's the slightly wealthier end of that, I'd call it, who have, and they are driven very much by impact. That's what they want, and they like the diversification, etc. But it's the impact. And then on the institutional side, pension funds in Nordic area, UK, US, as well as some foundations, endowments, and we're in the real assets bucket. That's where we sit. We're not like a leveraged buyout bucket in their portfolio. So they're shooting for, let's call it 8% net rates of return as typical, and we're in the same bucket as forestry and farmland and some natural resource type investments. So we're in that category. And then because we're in Africa, we're slightly riskier just because of our location, and so investors would hope for higher than that, a little bit higher, to justify being in there. But the investor base is mostly US and it's US and Europe. We don't have strong contacts in Asia and Middle East, perhaps that's why, but that's been our bread and butter.
And that's interesting. So people aren't putting you into a specific impact investment bucket. You're a diversifying alternative asset. Exactly.
So as an example, if you're a pension fund in the US or in Denmark or Finland, we might sit in the real assets bucket. What else have they? Let's say they've got 8 to 10% of their portfolio there, and inside that bucket they've got timber, they've got US farmland, and they've got natural gas pipelines and various stuff like that, various infrastructure type investment perhaps. And then we sit alongside that. And why is that of interest to them? Well, we're producing a cash flow linked to inflation, linked to food inflation. It's $1 cash flow, and we're backed by real assets, so it's tangible assets. It's genuinely diversifying its food. It's not oil or something like it. It's not cyclical, dependent on the main cycles globally. It doesn't matter about China or Brexit. It's just on its own. And so, like in the pandemic, none of our businesses had any hiccups on production or markets. It's basic stuff that people eat. And so that cash flow linked to inflation with real asset backing is very interesting, particularly the next decade. If you think about it from now, with all the debt that's come on globally, a large number of investors are worried about inflation, and this is perhaps a reasonable yielding. It's called an 8% type return. That if inflation suddenly went up, you should go up. You should see the return go up with inflation. So that's interesting. Yeah.
I think that's fantastic as well, and hopefully addresses that skepticism that people have about it standing up on its own 2 feet. John, I'll hand over to you.
Okay, good. Thank you very much, Gary, Renee. It's quite inspiring. I'm sorry that we only have 30 minutes to talk about this, but we'll come back to this topic in the future, maybe with a full webinar. Final words of wisdom. Gary, what are your final words of wisdom for the audience?
I think you should try and focus on impact investing. Choose your target group carefully and set your objectives up front. You're going to create a positive impact in the following way and measure them and report back to investors. If you do that, a lot of people are going to help you. You're much more likely to succeed than if you go down a normal investor track. I think in the future, it's just going to become more and more relevant.
Thank you very much. And Renee, last word to you, and then we'll turn it over to Zofia.
So for me, I think the more evidence we can have like this, that there is intentional environmental and social impact alongside a very good financial return, it's possible. I think it's really exciting. There's mythology around social impact investment and impact investment. And the more bits of evidence like this we can put out there, hopefully we can really get momentum up behind impact investment.
Great.
Thanks so much, Rennie. Thanks, John.
Great, thank you. I think Sophia's coming back from Jersey conference now.
I'm back. Thank you so much. It was a really insightful 30 minutes. I was listening. I just want to say that we will be back, as this was our last event of 2020. We'll be back on the 11th of January with our Walk in My Shoes, where we'll be looking at family philanthropy. So from all of us at Philanthropy Impact, have a great holiday season, and we will see you in the new year. Thanks. Bye-bye.
Thank you.
Thanks, everyone.
Thanks
a lot.
Bye.
Thank you. Bye.